Good afternoon, everyone. My name is Brian Overby. I am the Senior Options Strategist at OptionsPlay. And we're going to do a presentation. We're trying to keep it a half hour, but man, it's going to be tough. Mainly because I have a lot of material to cover. We're going to look at adjusting like a pro. We're going to look at how we adjust our long vertical spreads. We're going to focus on the debit side of things. So we're talking about a bull call spread and a bull put spread. And inside the OptionsPlay platform, a lot of the OptionsPlay number is centered around whenever you're looking at long spreads, doing something where you at least have a 2-to-1 risk reward ratio. In other words, if I'm going to risk $1, I want to be able to make $2 on our capital. And we'll do that around an earnings catalyst. We maybe see something in a chart that would draw our attention. So it's something where we're a little bit more bullish than we normally would be, and that's why we're doing this type of a strategy instead of a more neutral theta neutral type trade. We're looking for a catalyst that can drive us to the upside. So I'm going to actually work through a scenario that we put together for a daily play, and I'm going to talk about a couple of other scenarios that are involved. So before we get started, always have to let you know that we're going to be showing you some real securities today. We're going to be looking at the OptionsPlay platform, and nothing that you see will be meant to be a recommendation. We just want to make sure that you are aware of that. We do have a chat box and we do have a Q&A box. If you see the Q&A box, that is made just for questions. It's Q&A, named Q&A for a reason. So if you have a question, it's easier if you put that in the chat box inside the webinar chat. Feel free to chat amongst yourselves if you would like. I think almost everybody that's here today is a member of OptionsPlay, so feel free to chat amongst yourself. This seminar we actually didn't market to the masses. Let's put it that way. All right. I see Stephen. Where can I find information on synthetic relationships? All right. Well, a copy of my book can be found on a couple of places. You can actually buy it on Amazon, or you can just look up optionsplaybook.com. There is a lot. All that information is available for you. Synthetic relationships, I'm not really sure. I don't have anything right off the top of my head, and I don't have a webinar that I've done recently on those comments. But let's get into the presentation, Stephen. I'll see if I can try to figure out something to send your way a little bit later. Unlock superior returns with OptionsPlay. If you're not a member yet, this is the time. Get your phone up, scan, sign up for the 30-day free trial. Everything that we show you today will be available, and there is no commitment needed. All you got to do is sign up, create a profile, and you will have access to all the tools we're going to show today. And I always want to talk about Tony's presentation. He takes so much time over the weekend to put this together, and every Monday morning he goes through all the stocks. And one of the stocks we're going to highlight today, I actually used it as a daily play this morning, and it is inside his research report. And if you'd like to learn more about that, you can scan this and you'll get all the reminders to all the reports going out for a couple of months in time via the Zoom platform when you register. All right, vertical spreads. We'll talk about what a vertical spread is, but this is a little bit more advanced. If you have not, if the term vertical spread or debit spread or long call spread or long put spread scares you a little bit, this is going to be a little bit advanced for you because we're going to assume you understand the setup, and then we're going to talk about the roll. And in my mind, it's really an adjustment. Rolls is a term that is used a lot, but we are going to be rolling an option contract to adjust the trade and affect the risk. And then lastly, we have, the vernacular that goes along with adjusting the trades. We're kind of talking about that right now as we speak. And then we're going to get into some Q&A at the end. So trying to get through this, trying to make these a little bit shorter, a little bit more easier to, digest overall. But it is tough because one of the problems that we have is we get so many questions because we have such a great group of attendees, honestly. So 1 second here, I'm going to adjust this, and then away we go. Okay, so all of vertical spread means that you're going to buy a call and then you're going to sell a call against it. The call that you buy is going to be the more expensive one. The one that you sell is going to be the least expensive one. You're trying to offset time decay. This is 100% a trade that you're looking at as opposed to buying the option outright. If you buy the option outright, you have unlimited upside, but you have substantial downside. So in particular, if you're going around a known event like an earnings report, which we're getting to the tail end of earnings right now, bull call spreads and bear put spreads, where we buy the more expensive option, sell the less expensive option, are very popular strategies because of what can happen around a known event like earnings, what can happen to volatility, those type of things in those trades. So let's go and quickly set up a trade, and then we'll talk about the roll. So this is all about adjustments today. Like I said, we're flying over the vertical spread information and all that. So if you are going to look at a spread or any type of option contracts, probably the most common term where you hear roll is when you're thinking about a covered call situation where you sell a call against the stock that you own. That call option becomes in the money. You roll the option contract to try to avoid assignment. That isn't going to be the case here, but that terminology still applies to our adjustment. So there are a few things that you can do. One of the things is you can roll up. You can buy a lower strike option contract and sell a higher strike option contract in the same expiration. So that we call that rolling up. You can roll down. In this instance, you would have a higher strike option contract. If we're talking about calls, I should emphasize that. And you are rolling down to a lower strike contract that's in the same expiration. So if we're looking at the call sides, we're rolling up or we're rolling down. Bottom line is the strikes are going to be the same. So even if you're talking about puts or calls, you're still rolling up or rolling down. Now you can roll out. You can keep the same strike and just say, and if you think of a covered call scenario, you might just say, I want to kick the can down the road. This expiration is approaching. My option contract is in the money. If I roll out in time and keep the same expiration, maybe the stock will come back down and eventually finish below the strike price. So sometimes you just roll out, and that just means that you're buying to close the nearer term expiration, and then you're selling to open the farther out expiration. Now, more common, especially in the covered call scenario, is you roll up and or down, but then you roll out. So in other words, using the covered call scenario, we would roll up in strike and then out in time, and hence the more time premium offsets the loss on the position that we actually have, because we're going to get assigned on our short call option. So you're rolling up and you're rolling out in time. So these are the three types of rolls. We're going to actually concentrate more on this, rolling up or rolling down in the same expiration. And in order to have that opportunity, it's all about how you set up your spreads, though. All right. So the vernacular. Order tickets are really complicated, but it has everything to do with open interest. Open interest is calculated by the number of tickets that show up at the exchange or at the Options Clearing Corporation, to be more accurate, and they're marked buy to open or sell to open or buy to close or sell to close, because it's very easy to sell an option contract without owning it. That means that you're opening the position. So this is the vernacular on the order entry. If you're looking at tickets, we're going to be when we're rolling a trade, we're going to do a combination of these. We're going to either be buying to open or buying to close or selling to open and then buying to open. So if we're buying to close, we're going to sell to open. If we are selling to close, we're probably buying to open. And that's the way the vernacular and the way the order tickets are going to work. All right. So I have an example I made from a while back, not that long ago, where I actually took the time to use real quotes in JP Morgan and adjust those quotes within the chain and look at adjusting the JP Morgan trade if it went against you or if it went with you. And once again, we're focusing on the bull side of things, or we're focusing on the long side of things, paying for this trade. So JP Morgan was trading at 274 at the time that this trade was put on. We had 70 days to expiration, went out quite a bit in time. The options play score on it was 104, meaning that we had a decent risk reward ratio, how much we are risking relative to how much the reward was. And in this instance, we had a 30-point wide spread, fairly expensive stock. To start with, we're paying $1,133 to put the trade on. So it's nothing to sneeze at, right? We're just looking at one contract here. And if we put on that trade, we're going to go through a scenario where, let's say the market went up, or let's say the market went down. We got plenty of days to expiration. So that's a very important point to emphasize. If you don't have days to expiration, then you really can't you can't adjust. You know, I always kind of chuckle a little bit at the questions. Is we'll have, like, I'll get a lot of people that will ask me, well, I did a bull call spread and there's 5 days remaining to expiration and the options are out of the money. What can I do to save the position? And to me, that's like equating, well, I just drove my car off the cliff. Car mechanic or auto body shop, can you please repair it? No, it's totaled. The position's totaled. You got to talk to your insurance company. They need to give you a check to buy a new car because there's no repairing it at that point. And that's what's important, is understanding that if you're trading options, you need time to be able to adjust. And if you don't have time, then you're talking about zero DTE options, right? You're not adjusting zero DTE options because you got 1 day. They live for a day, and that's it. And there's really no chance to adjust it. Few and far between. I mean, obviously, there's no absolutes in the options trading world. But when it comes to these type of trades, if you want to adjust, you need time. Moral to the story. All right, so here's our first example. We're going to talk about rolling up. Here's the position. Now, these were done with real numbers, right? I did adjust the strikes, but obviously JP Morgan didn't go up and down at the same time. So I adjusted the position and pretended it went up, and then I adjusted the position and pretended it went down. And I used the actual option change to come up with these strikes. So, for example, JP Morgan was at 274.03, 70 days to expiration. We bought to open the 270 strike for $13, sold to open the 300 strike for $2.11. It's an expensive trade. Stock is at 274, so we're a little bit out in the money and we're a lot out of the money. All right, I hope that made sense. Went through it quick. $11.33 to put the trade on per 1-by-1 spread. So you take that number and you multiply it by 100 and you come up with $1,133 for that trade. Now, JP Morgan stock ran up 15. 35 days, it took half the time. We had half the move approximately. Maybe a little right in the middle. We'll call it half. We'll round a little bit to that. And in this situation, now our in the money call is doing really well. It was trading for $13. It's now trading for $21. And so what we're going to do is we're going to try to capture that gain. Now, if you do this, if I'm doing this trade, I want to make sure that I'm taking all the money off the table. And this is just quite simple, that I don't want, and obviously I got to be still bullish on JP Morgan. I still have to think that the underlying stock is going to go up and be able to reach our strike. So to do this, what we're going to do is we're going to sell the close, the 270, and we're going to take this profit. This is a gain. The money's off the table. You cannot lose the difference between where the stock was at on day 70 and where it's at now on day 35. But we're still bullish. So we're going to buy a cheaper option contract. So instead of selling this and getting the full $21 minus whatever it costs to buy our callback, we bring this in, we get a net credit of $12.15. We paid $11.33 for it. So now here's our new position. With 200, with the stock at 289, up $15, which isn't a ton on a $270 stock on a percentage basis. So just keep that in mind. $15 is a lot of points, but on a percentage basis, that's a very viable move in JP Morgan. With 35 days remaining, we see that right now we have a net credit of 82 cents to the account. We made the trade, we're up on it. We cannot lose on this position. You feel a little bit more like you can hang in, you can play the hope game if you'd like a little bit, right? Because you have 35 days remaining to expiration. On our long spreads, I usually have two rules in that. I'm going to look, if I started with 70 days and I don't do anything with the trade and I get down to 20 days, I'm going to close it. I might be up a little, I might be down. Bottom line is I'm going to get out at day 20. That simple. If I adjust it, I'll allow myself a little bit of leeway in that I've either taken some money off the table most of the time, and sometimes if you're losing on the position, you might be like, gosh, I really still feel bullish. There's got to be a reason or a rationale why you want to continue to be in the stock. But in this instance, now you are long JP Morgan with the stock at 289, 35 days remaining, and you still have the potential to make $15 more on the upside. You put the trade on, you were profitable on the trade, you decided to roll. Now you can make an extra $15 and you put it on for 82 cents. If the stock were to reach 300, you would make $15 plus the net credit of 82, which is the cost basis. That's why I have it in green, the difference between this and this. And you'd be able to make $15.82 above and beyond the net credit that was initially received from putting on the trade. All right, what does this do? Well, one of the biggest things is that it allows time decay to happen in the option contracts, and you need this option contract to go to 0 by that expiration date. Now remember, that's ran up because the stock has ran up, so you need time premium to erode. And at day 35, you're still not getting a huge amount of time decay at wherever the 300 strike call is at. And then on top of it, you still have some, you notice here that we started 4 points in the money, and we're still 4 points in the money. So we're still keeping the same thing. We're just saying that, okay, we've made a good run up. 300 is fine. We're going to see if we can make a little bit more on top of the trade. All right. And here's the beautiful thing here is that, does rolling create a tax wash situation? It can, Felix. I mean, this isn't a tax seminar, but Felix is asking about a tax wash situation. It gets a little tricky with options, and I am definitely not a tax advisor, but it does, because it does depend on what option you're buying and what option you're selling. If it's a like position, it's supposed to be a wash sale. So, you know, there's a lot of leeway in the way that you can approach what is considered a wash sale. Okay, what about assignment before expiration? Well, that does happen. One of the biggest things about assignment, and this is from Mitch, one of the biggest things about assignment before expiration is part of the reasons why the platform, it's not why, but in general, when we're making basic trades and we're setting up trades, usually we'll go a little bit further out in time because assignment is an issue and it can create an issue. But you're more concerned about it on 0 DTE options. And that's part of the reason why if I'm trading shorter term options, I like to do them in indexes. Something that is cash settled as opposed to settle in the underlying ETF or stock. But in this instance, I'm not going to get assigned with 35 days remaining. Very, very rarely. I mean, a stock would maybe have to pay a huge dividend. But if that does happen, don't panic. Okay. And I did do a seminar about option trading landmines, and that's one of them. Realize that your risk is still defined. So well, first of all, you're in control too. So this is a different scenario. But it sounds like that happened to you, Mitch. Maybe we take that one offline here in a little bit. Can you do an example on credit spreads? I don't know if I have one on credit spreads. I don't know if I'll be able to get into that as much. But, well, we'll talk, the concepts stay the same. If you're wide enough on your trading that you can roll within the same expiration and you have enough time premium, it allows you to do that. It allows you to trade that position. I don't ever want, I should say in a 40, 50, 60 day scenario, I don't want to continue to adjust the position. I really only want to adjust once because you have bid-ask spreads, you have fees to get into trades. And the more you adjust, the more you're dealing with that and the less of a possibility of being profitable because it's getting eaten up by commissions and by bid-ask spreads. So in this instance, I'm usually looking to adjust once. And I don't know if we're going to do an example on a credit spread today, only because that's not what the seminar is about. Okay? But the concepts still apply, rolling up, rolling out. So now here's one where we're going to roll down. So we're going to, instead of going 15 points up, we're going to go 15 points down. So we're losing on this position. And I want to emphasize that this doesn't look awesome, right? Why? Because the stock went against us 15 points. But in this scenario, what we're going to look to do is say, okay, we're now still at day 35. And once again, these are real prices. I adjusted them. And this option contract has basically gone away. It was trading for $2.10. Now, there's no reason to hold it. If anything, just close it, right? Why would you hold on to this position for 10 cents and hopefully get 10 cents over the next 15 days? So it's just really straightforward that if you're not going to roll it, at least close it. And then if something by chance happens, Goldman Sachs buys out JP Morgan in the short term, right? Obviously a fictitious scenario, but that happens, then at least you get the benefit of being long 270 strike call naked long. That's not a bad thing if there's a big news event. So there's no reason to keep it. So you roll it and you get a net credit of 160 to the account. I looked at the prices on this. If you were to close this, out, you would have received approximately $3. Okay, so we put the trade on for $11.33. We're down to a point where you want to get out of the trade. Normally, our risk would say that around $5.50 you'd get out, about 50% of the trade. That's the actual rules that are embedded in the OptionsPlay platform. So now you're trading at $3. Are you going to get out or are you going to make an adjustment? What is your outlook on the trade? You got plenty of time left. So in this instance, we buy to close that. We look at the 285 strike. I don't want the cheese anymore. Just let me out of the trap scenario. 300, that was great when we started, but we'll gladly take 285 at this point in time. Bring in a net credit of 160 to the account. Our cost basis, and I got it in red this time because we're down, is 1130 minus the 160. We still got potential for the stock to make it back to 285. We've given ourselves a few days. This position would be on a short leash if we did this, and realize that if you just sold the trade, your only caption, maybe it was $3.20. I got it written in the notes. I'm not going to hit escape to go back and look at it. But all you're doing, you're making about half of it, and you still have a position on. So in the poker world, they call it, I have a chip in a chair. And here's the other thing, is part of the reason why I like this, especially with beginning option traders, is they can't close out positions. A lot of people they say to themselves, yeah, if I'm down 50% on the trade, I'm going to get out of this trade no matter what. And then it happens, they say, yeah, but the Bollinger Band ran into the moving average and it hit the Fibonacci number and then the sky turned blue. And heck, I think the stock's going to come back, right? Well, if you're that type of person, do something. Right? And this is the trade that I'm saying you should do. You should looking at rolling this strike down. Now, 35 days, we're long the 270, long the 285. Still not a great scenario. We still got some upside potential. So we're still talking about 15 points that it could trade for. And right now it's for $9.73. If I'm doing this, I don't want the cheese anymore. Just let me out of the trap. What were the deltas on the options? Well, the ones that I'm gonna guess here because I don't have ProMod. I don't have it off the top of my head, but the one option to start with was a little bit in the money, probably 60 delta. The one option that we were selling were probably, and the platform will usually pick something like this, right around a 20 delta. All right. And that's just general. That's what I've always noticed throughout the OptionsPlay platform, that usually holds true and gives you that, at least 2-to-1 or better risk reward ratio. Okay, so here's a question from Julio that is all about the roll. So here we go. So in this JP Morgan initial example, you rolled the 270 call to 285 with 35 days left and left the 300 as the original position, correct? No, that is not correct. So we're buying to close the 300 in this example right here. And so your finishing position is 270, 285. So that's what I mean by 300 was great when we started. Now we're willing to take 285. We'd be happy. We don't want the cheese anymore. Just let us out of the trap. If we do this, we can still be profitable on the trade, but we're not going to be massively profitable like if our forecast would have been correct in the first place. Did not roll the full spread. And that's exactly, so that's a great question. So let's go all the way back to here. So here's what we're doing on this trade is we are rolling down and rolling up in the same expiration. And you can only do this if you have time, if you set it up with time, and you had your spread wide enough that it made sense to do it. You obviously, if you're 5 points wide on your spread, it's going to be very hard to roll it down and make that spread 2.5 points, right? So it's about the setup. It's about the concept that if you do set it up a lot, the way the OptionsPlay platform sets them up, the default on the strategies, this is a viable situation, and you're rolling up and or down. And that was the two scenarios we went through. Okay. So then the question is, why not? So here comes another question about it. Why not roll? See, this is where adjustments are really, really tough and hard. In my book, I don't have a lot on adjustments because there are so many different ways that you can do it. This is a way that I find interesting. And I'm going to go through a daily play in Goldman Sachs and just talk about exactly where this one would apply. But we had one of the questions, why not roll down and out if you're still bullish? Sure, you can. And if you were in a scenario where you had very little time remaining, well, yeah, that might be a viable scenario, right? There's no golden book of answers. But I think a lot of people already know that you can roll down and out the entire trade if you want. In my opinion on trades like this, something has changed, right? I very rarely will take an entire long call spread and roll that down and out or up and out or anything because I was obviously wrong on my forecast. Right? So I usually would just close the trade and move on. This is a scenario where I still got an opportunity, right? I'm not giving up just yet. I'm taking a good chunk of money off the table, but I'm not saying I'm done. I'm not tapping out. If I roll down and out, in my mind, I'm tapping out. I'm just closing a position and opening a new one. And usually that means that you're doing that into momentum in the wrong direction, right? So no, I don't like it as much, but everything's possible. And if you didn't have as much time premium, this opportunity wouldn't be available to you. Stephen, it matters on the underlying. Stephen is asking, what would you consider a good width? 20, 30 points, etc. It does matter on the underlying. If you're doing a $30 stock, you can't go 30 points wide, right? Because you're talking about a 100% move in the underlying stock. So it's hard to say, Stephen. So this might not work if you're doing this in, what was it? Well, we got financials, Charles Schwab is a $100 stock now, 90 something. I'm trying to think of a good financial stock where it's a little bit different. Okay, and Vicky just asked a general question about a vendor and where a lot of our members actually trade, which is at Thinkorswim. Can I use the roll position to roll this option? Yeah, this is exactly what this is made for. You right click and you can roll that position if you would like. That's exactly what this is for. All right, so yeah, definitely. Let's get going. All right, so I got one more scenario here, and like I said, it's hard to see. We're right at a half hour, so let me get through this. I'm going to fly through it. This is a true daily play. It just happened on July 10th. This scenario is going to turn out just fine. We also did one in Goldman Sachs, and we lost a little bit because we adjusted. And it's that simple. This one that I'm showing you, I think, is the perfect scenario of how a roll really worked out. We did the same scenario in Morgan Stanley because these are both stocks that are, in the mergers and acquisitions, IPOs, deal-making stocks. And so that was my thought about getting bullish, as I still am bullish in general in this area because I do think things will loosen up. There's just a lot of questions. We got to get through September and October. The crazy months ahead, nobody ever knows why, but the markets seem to get more volatile in those time periods. Okay, Goldman Sachs, let's get into it. Goldman Sachs approaches the July 16th expiration. We put this out as a daily play on July 10th, 2025. The earnings were on the 16th. So we have a catalyst. I'm not going to sell a short put spread. If the forecast is correct and we get the type of movement that we want to get paid for it. So in this instance, it's an expensive option. You're buying, you got a very expensive underlying stock. Stock was at 696.56. Now realize this is July 10th. The trade was put on or the email was sent. So this is actually the 9th. This is the close on the 9th. We looked at doing a bull call spread. We went quite a bit wide, 695 to 755. So we're going just a little bit in the money, selling way out of the money, but still getting a lot of premium 43 days out. And that has a lot to do with the earnings. Okay. So if that catalyst does kick it to the upside, well, we got a lot of room for the underlying to run. That's simple. All right. So here is the actual daily play. I just cut and paste the text from the email into here. I'm not going to go through it. You can look at it if you would like, but you will have access to these slides later on. Okay, so now here's what happens. Goldman Sachs daily play on the 10th. The stock didn't move as much. I guess I'm not going to get into a huge detail on my outlook of the underlying stock. But when we put the trade together, if you notice, this is actually the chart from the OptionsPlay platform. I just cut and paste it. 710 was the day that we put it on. The close was here. July 16th is right in here when the earnings were. And the stock went nowhere, right? The stock actually made a strong move up after the earnings report. Everything they beat on the top line and bottom line. And the stock just really didn't do much. But eventually, a couple other stocks announced earnings that were in the space. Goldman is usually one of the first ones to announce. Stock starts running up. Did a fairly good scenario. All right, so now we're profitable. We were never down on the trade. The stock was here. Never really were at a loss on the trade because we set up a long spread and the volatility was coming out of our long option. All right, so a few days go by. Now we are on the 7th. We are profitable on the trade. We are getting down in the days to expiration. At that point in time, I think we're down to 20 some days, maybe. We'll see on the next slide. I don't remember exactly, but this was the day. This was the close. 7/19/74, we sent out an email in the morning saying we're going to adjust this trade. We are profitable on it. We could take the profit, but we're not as profitable and we're still bullish on the underlying, okay? So here's the adjustment trade that went out. It was August 8th. Remember, this quote was from the day before, the 7th. This is the 8th. Stock was at 7/19/74. We started with the stock at $696 is about where it was, and now it's at we'll call it 720. 14 days to expiration. So part of the reason why looking at this trade is, once again, we're at that range where you just close it. We're slightly profitable on the trade, probably medium profitable on the trade. Do we close it or do we do something, right? Not up as much as we would like to on the trade, so I decided personally to just roll this position. Once again, 755 was great. We had an earnings catalyst. The catalyst has gone away. The vol has came off. We still got a lot of premium because it's a $700 stock. Let's close this. It still has time in it. So the marketplace is still assuming that it could get to that level just by the price of the option. And we're going to buy to close that, and then we're going to sell the 730 and bring in $11. Net credit was $7.44 if we filled at the midpoint. So you receive $744 for the roll. It's a 1-by-1 position, so it's apples to apples. The total risk for the new position, when we put it on, it was $2,290. You subtract that. Now our total cost basis is $1,546. All right, here's our resulting position. This all happened. We went through all of this. All right, so stock moves again. Now we only got 14 days, so we're watching this intently. And like I said, just in general, the rule is, the last 7 days to expiration, you got a lot going on with gamma and theta. You usually want to be out of that position by then. And luckily, we got the move that allowed us to get out. So on the 12th, the stock closed at 743. So on the 13th, so you got this big green candle, and it closed on the high end of it because it's green. And this was the closing price. So we put in the close. Why? Well, we only had about 10 days remaining to expiration. And because we adjusted it, we ended up making a 97% gain on the position. Why? Because not only did we capture the time premium from the original trade that we did, we also captured the additional time premium from the roll, from that option contract. So we made on 2 short options as opposed to just 1. So the gain ended up being 97%. We sold it at $29.97, and our gain therefore was $1,474 on the entire position. Once you adjusted for the net debit that was on the trade. All right, so I flew through it. Now, I don't always just want to talk about winners. This was an interesting scenario. We did a scenario in JP Morgan where it would be a loser, but we also did this exact same scenario around earnings in Morgan Stanley, and that position recently was closed at a small loss, but the adjustment allowed us to get out at a small loss as opposed to a bigger loss, and it was the same type of rationale and the same outlook. Still bullish on Goldman. A longer term bullish, adjusted the position now to be a very long-term long call, but the dynamics of the marketplace has changed, right? There's no earnings report that's in there. We do have September and October, which do make you nervous. Financials, there's a lot going on with the Fed. Friday, we're going to hear from Jay Powell and what's going to happen with interest rates. But the bottom line is the spread between the 10 and the 2, as far as interest rates are concerned, has been positive for the banks overall. Okay. So here you go. Click it. OptionsPlay.com, sign up, 30-day trial, and I went long again. My name is Brian Overby. Follow me on X. My handle is @BrianOverby. OptionsPlay.com is the site. Get the free trial. My book is called The Options Playbook. You can buy it on Amazon. All right, let me address a few questions and then we'll call it a day. So at this point in time, we always like to take a small stoppage and say we're going to address some questions. And this part of the presentation is set up for members. And so we're going to address the members' questions. And if you are watching this in the record, thank you so much for coming in. And I always like to leave you with this little note. May all the options that you buy finish in the money, and all the ones you sold finish out. Thanks for tuning in.